2015 was another bumper year for the Irish industrial and logistics sector of the property market, with a large number of transactions significantly boosting the volume of take-up. This in turn led to a notable decline in the availability of modern premises in highly sought-after corridors around the M50. With only one speculative industrial building currently under construction in the Dublin market, this shortage of modern accommodation will prevail for some time yet, which in turn will put significant upward pressure on rental and capital values in this sector over the course of the next 12 months. The likelihood is that take-up in the industrial and logistics property market in 2016 will, for the most part, be comprised of fewer large sales and lettings than those signed in 2015. The overall volume of take-up in 2016 is likely to be down year on year as a result. In any event, the domestic economy continues to recover, and we expect to see stronger demand for smaller lot sizes emerging from indigenous occupiers. In addition to demand from the data centre, biopharmaceutical, medtech and food sectors, we also expect to see a considerable demand for industrial premises emanating from the logistic and distribution sector as a result of the growth in private consumption and retail sales that has become increasingly evident in the Irish economy over the last 2 years. Indeed, with the growth of e-commerce and online sales, the dynamic between supply chains and the logistics sector continues to evolve. As has been the case for several years now, modern industrial and logistics properties along the M1, M2 and M3 corridors close to the M50 and Dublin Airport, as well as along the N7 corridor in Dublin, are likely to be the most highly sought after. As had been forecast, prime industrial rents in Dublin reached €75 per square metre by the end of last year, reflecting a 15% uplift year on year. However, we are expecting an even stronger rental growth in this sector in 2016, considering the inherent shortage of modern accommodation and the lack of new supply coming on stream in the short term to meet demand. We anticipate prime rents rising by as much as 25% to €94 per square metre by the end of 2016, which will, in turn, render new development viable and kickstart the development cycle in this sector of the market. The industrial market is generally known for its ability to respond quickly to demand cycles due to the relatively short construction period for industrial buildings. While we expect to see stronger appetite for well-located industrial sites and an increase in the number of planning applications for industrial schemes being lodged this year, few speculative schemes are likely to commence until such time as rents rise to a level where development is actually viable. The one exception will be a large speculative scheme along the N7 corridor, which is due to commence construction in the first half of 2016. Development will primarily be focused on the key corridors located close to the junctions along the M50 initially. Although there has been some improvement in the availability of funding for viable industrial and logistics businesses looking to expand and indeed relocate, the availability of debt funding for speculative development is going to remain elusive for some time yet. We expect to see an increase in design and build projects in 2016, with work commencing on a number of data centre projects throughout the country, including a facility for Facebook at Clonee, County Meath, facilities for Microsoft at Grange Castle and Google at Profile Park in West Dublin, and a facility for Apple at Athenry, County Galway. Although there is a presumption that data centres can only be facilitated in large purpose-built premises, they can also be accommodated in existing buildings, as they don't require the same eaves heights that many modern occupiers require. With the availability of modern premises low and economic conditions improving, we expect to see further strengthening in lease terms in 2016, with a greater proportion of industrial leases extending to 10 years or more, and a notable reduction in the number of properties being let on short-term arrangements other than in secondary and provincial locations. As the appetite for yield escalates over the course of the next 12 months, we expect to see continued demand for good industrial investment opportunities, particularly considering rental growth expectations in this sector. However, sourcing good quality investment opportunities of sufficient scale will remain challenging, with the greatest availability of product likely to emanate from the secondary trading of assets from loan portfolios purchased over the last number of years. In summary, we are expecting another busy year in the industrial and logistics sector of the market. However, the biggest challenge over the next 12 months will clearly be a shortage of modern premises in the areas where occupiers particularly want to locate.